All right, ladies and gentlemen, welcome back to Finom Group's weekly State of the Market. I am your host, as usual, Seth Golden, and I am once again joined by Brad Carter, and we are watching this market through the first month and a couple days now. We've traveled into the month of February. We are still in the sweet spot of the presidential elections, the 4-year presidential cycle, which we had talked about coming into this year, and how strong that particular cycle is of any of the four-year period within a presidential cycle. So welcome back to Finom Group State of the Market. And I guess, my first question here for this week is, Brad, today we are officially intraday, we're not closed yet, but intraday we've in the S&P 500, we've officially moved 20% off the low, technically a new bull market, right? And we achieved a 50% retracement of the bear market decline. Again, intraday, we'll see, where we finish the day here. But, what are your overarching views on this melt up here year to date? And how are you, managing the gains? Because if you were long into this year, you have the opportunity. We all have the opportunity to take some profits and reposition if that's part of our game plan. So how are you managing this melt up here?
I'm working very hard to not allow it to change my game plan too much. I've been telling you for a couple of months that I'm optimistic about this year. I'm still optimistic about this year. It got off to a better start than I thought it would, but I'm still hanging on to some cash quite a bit, selling the rips, buying the dips. I don't know if I've ever said this before, but I generally don't sell out of any stock for a period of time. When I've decided to buy it, I don't just make trades, but I trade around a core a lot.
Right.
And that's always paid well for me. So,
let me interrupt you because you had introduced last week, what was it? Not Domino's Pizza, but
Papa John's.
Papa John's. How's that been?
Hey. Well, it's doing to me the same thing it did the last time I bought it a couple of years ago, I think. I decided to get into it small, thinking, okay, I hope it goes down. I'm going to buy some more. No, it just takes off. And it did, and I've managed to sell just a little bit of it and buy a little bit of it back. And I sold a little bit more. Was it yesterday or today, I think? So I still don't have the number of shares I would like to have in it. I think I bought it around 80. I incorrectly said I bought it in the high 70s last time, but that's where I started watching it. It was just over 80 when I bought it. And before you knew it, it was sitting at 95 a share. I mean,
yeah, that's right. I recall the telegram you were saying something about 94 and change.
So I'm staying with that stock. I didn't get in it just to get a quick $10 a share and get out.
Right.
But like it did last time, is trying to get away from me a little bit.
Isn't it always the way? We have too much of what we don't want because it's working against us, and not enough of what we is working for us in our portfolios. It's just that's just the conundrum.
It reminds me, Seth, of something I wanted to talk about today. That very, very, very thing. Anytime you catch yourself going, darn, I wish I had more shares of that. Don't, because that just means you're applying your disciplines to all your buying and selling. Sometimes they're just going to do better than you thought, and sometimes they're going to do worse than you thought, and then you react after the fact appropriately. I mean, I'm still sitting on about 40% cash. And
and in this market, we're bound to get a pullback. It's not a matter of if, it's more a matter of when. And the composition of how this market has melted up through January into early February suggests that there are a lot of stocks that should not be going up. Some of the, unprofitable tech stocks, some of the Carvanas and Beyond Meat. I think Beyond Meat is up like 50%. in just the last couple of weeks. And these are companies that were formerly meme stocks. So, when you see that as part of this overall melt up, when reality sets in for those names, it creates a headwind for the indexes, for the overall indexes. So I would be anticipating that.
Yeah, they still have to do quarterly reports.
Yeah, they have to face the music each quarter.
Yeah.
They have to face the music.
Is Beyond Meat can we get short shares of that usually? Or?
Oh yeah, they're available in droves. I put out my order. I'd like to see it to get to 22. I don't know if it will. But this stock was formerly $11-12 a share, rightfully so, not oversold. The fundamentals demanded that. Yeah. So I think I had talked about today with Finom Group members that look, in bear markets you're getting value, so you buy that value. In bull markets, sometimes the stocks that shouldn't go up with the overall market do. So you're getting the opportunity to short fundamental overvalued situations. And in my opinion, the Carvanas, the Beyond Meats, even Bed Bath & Beyond, which is again on the border of filing for their bankruptcy protection, has melted close to $3 a share recently. So that that just shows you composition of this market. There's a lot of short covering, but lately, including yesterday definitely you saw a lot more actual buying than short covering. Yep. And after the bell is kind of what bleeded here today when we got the results from Meta, far better than anticipated, and seems like the worst of that saga is over. We'll get more information on that front after the closing bell today with Amazon, Alphabet, and Apple, of course. So, like I said before, and I think that's what you're hinting at, nobody should find FOMO creeping into their game plan. The market will come back in some. We're not just going to continue to go up without these fits and starts, so to speak. So being patient, still having cash, that cash will get allocated if that's if you're patient throughout the course of this year. One of the other things I had wanted to mention, because more than likely this move in the NASDAQ is going to trigger oversold conditions. The McClellan oscillators are getting stretched beyond their norms. That usually spells a near-term consolidation as well. All right, everybody. So again, welcome to our State of the Market. Headline from the Wall Street Journal. As you can see it there on December 31st, 2022, stocks log worst year since 2008. Things have, the character of the market has changed. Things have shifted. And now investors are, there's a lot of folks out there. I wish I had bought the October lows. I wish I had bought November last year. I wish I had bought December, last year as well. You don't have to wish, but you do have to execute. Stop being in the whole I wish camp and just recognize when the market is giving you value, take advantage. And, you can dollar cost average along the way. Something that we had talked about in our weekly research report 2 weeks ago, and I titled this, I extrapolated it from our weekly research report, How Fear Does Not Work. The human condition of losing capital is ever pervasive within the investing process. I would hope to remind investors that such a process is also a journey, a marathon, if you will. Those attempting to sprint to riches will likely fail spectacularly. Those who are willing to get rich slow, as Warren Buffett likes to call it, will not make magnificent headlines like those who participated in the meme stock rallies and hedge fund short squeezes of 2021. As history proves a useful guide, however, those fast money market participants of 2021 are largely gone, having more disastrously borne the brunt of the bear market losses of 2022. Luck and skill are two different concepts. And when it comes to investing, skill is more conducive to the investing process, which again is a marathon. So, this is just kind of centering us this within our weekly research. It just centers us. It helps us, to put things into perspective. 2022 is arduous, for most investors. But if you've been patient, if you've exercised discipline throughout 2022, and held true to your game plan, now here in 2023, you're being rewarded. You're getting rich slowly. You're getting rich slowly. And you're doing it in the face of, all of these strategists on Wall Street. This is Morgan Stanley, Mike Wilson, the team at Morgan Stanley. No economic recession, but rather an EPS recession. So they actually don't think we're going to have a recession, but earnings are going to have a year-over-year decline. They do believe you should be selling stocks, buying bonds with the yield curve inverted. The second half market will recover to about 4,000. Essentially, we're going to pretty much go nowhere throughout the course of this year. That's the team at Morgan Stanley. JP Morgan, led by Marko Kolanovic, who is typically bullish on the markets more often than not. In fact, if I was to put a percentage on Marko Kolanovic's bullish outlook, I'd say 90% of the time the guy's bullish. But he turned bearish in the fourth quarter of last year. He's remained with that bearish outlook here in the first quarter of this year. He says, fade the rally. Recession risk is delayed, but not exonerated. There's not enough positive catalyst for the market to go higher near term. Now, these were the notes for last week. The market is up another 3% here basically this week. Again, when we see these notes from strategists, from economists, remember, do they apply to you? Do they interrupt your game plan? Should they be incorporated into your game plan? It's one thing to digest the information flow, to get these notes from analysts. It's a whole other concept of, do they really have any practical utility for me and my game? And if you can say no, they don't, it's probably because you have a really sound long-term game plan and you know how to execute it. You have discipline. This should just be either confirming what you already have in your game plan, detracting from it to one degree or another, but it shouldn't override your game plan, in my opinion. Next up, we have the Lighthold Group. And most of you know that Jim Paulson, who was the chief equity strategist at the Lighthold Group, 40-year veteran of markets. He retired late last year, but Doug Ramsey has taken over, and these are his notes, basically saying risk-on markets signals, technical improvements and breadth thrust putting bears on their heels. 2022, it paid not to fight the tape or the Fed. 2023 signals suggest it is now the bears who are fighting the tape. The shoe is on the other foot or the other paw. And the only savings grace for the bears would be another Fed-induced market sell-off akin to the Jackson Hole event. I've been saying, since the start of this year, and when we've seen these breadth thrust and these bullish feats of strength in the market, that really the only savings grace here going forward is if Jerome Powell and the Fed help the bears out. Because there's too much of a buy the dip impulse when you get these breadth thrusts and when you have this bullish uptrend that's been confirmed, even catalyzed by these breadth thrusts. But we had the Fed meeting yesterday, and the market just, kept melting up throughout Jerome Powell's press conference. What was your takeaway, if I may, from Jerome Powell's press conference yesterday?
I first want to go back to about a week ago, and I don't remember if it was during the state of the market or you and I chatting before it, but we were talking about Powell, is he gonna bring out the big stick or not? And I was kind of not sure. I was kind of on the fence. And then just before he came out yesterday, I said, I think he's going to hit us with the strap, but not quite as hard. Well, he just showed us the strap. He didn't even use it. but be aware, because there's Bullard out there, and there's other
Mhm.
guys, and they're going to be out there making their
Yep.
statements.
Yeah.
I hope they, I almost hope there's a little selling in the market so we can go buy it all back, because I think the worst is in. I just do. It
Yeah.
just feels that way, and that's not based on me being, you know, the the brightest guy in the room. It's more on experience. Just
Mhm.
having, you know, Seth, when you first met me, I was a complete novice. I was a rookie. I mean, I was horrible.
2011, right? Yeah.
Yeah, and I had just started, I think maybe in 2010, with a few $100s in the stock market. And I think by the time I met you, I may have had 20 to 25,000. You know, it was a real small account. You had to pay commissions for, so trades were hard to
Mhm.
do. And, you know,
I remember the
and
$7 commissions you factored into the
yeah,
trading profit. Yeah.
yeah. And the smaller you are, the more you have to do that.
Hmm.
Now that's all gone, and of course I have several multiples of that in the market now, because I've learned, and a whole lot of it really is about experience. If you'll allow yourself to learn from it.
Yep. Yeah. The Fed is a passing phase. It's just a matter of what phase the Fed is in, but there's still, it's a passing regime. I listened, to yesterday's press conference, and I said to myself, in a roundabout way, he told market participants March and May and probably done. Now, if
Yeah,
you follow Fed Fund futures, that's pretty much what Fed Fund futures are pricing. Another quarter basis point hike in March and another one in May, getting you to just above 5%, which is what Fed presidents, regional Fed presidents, have been touting and signaling, for the last quarter or so. So there was no surprise there. But I think what the markets latched onto was confirmation from Jerome Powell. Like, he said the words, March and May
yeah.
are basically done. Probably time to hit the pause button and look around. Now, based on what we're seeing in the wage data, it doesn't suggest the Fed should go there. It suggests the Fed should stop now. But the Fed's, we'll see if we can get that much more powerful signals in the next round of inflation data. But the employment cost index that we just got on, I think, Monday or Tuesday this week says wage inflation is coming down. And that's a big component of why Fed officials believe that they need to keep hiking. But we also heard Jerome Powell confirm what we also heard from Lael Brainerd, the vice chair of the board of the FOMC, say previously, which is she didn't believe that there's a wage price spiral. And Jerome Powell reiterated that. So that combination of maybe just two more, we're confirming the terminal Fed fund rate, right? The market just wants to know for sure. That's the terminal Fed fund rate. And you don't believe that there's a wage price spiral situation. I mean, those were net positives. You can't really say they were bullish or they were hawkish or dovish comments. They were just confirming comments. And the market loves certainty. Market doesn't like uncertainty. You could make the argument all last year they had no certainty on where the terminal Fed fund rate would be, and the Fed marched out this concern about wages just remaining and continuing to go higher. So I think that's, again, what the market has latched onto and appreciates. Now, to your point, doesn't mean up in a straight line. We'll have, as you said, pullback opportunities. It's really just a matter of, do you as an investor have confidence? Do you believe in the signals, the breadth thrust, the fact that we have traveled 20% off the low? Again, that's technically a new bull market, at least intraday. What else? We've had a 50-day cross above the 150-day moving average. Again, historically, that's another bullish signal. 90% of the time, the market is higher 12 months later. If I say to you today, 90% of the time that the market has expressed these signals, it was higher 12 months later, would you buy the pullback? And, you know, you know, we would tend to say yes, but it's you know, when the opportunity actually presents itself, a lot of people know it's going to go lower. I'll wait. Don't wait. Just break up position sizes is what I say, and how I, you know, engage those pullbacks. One of the another bullish, I should say, strategist and firm is Oppenheimer, and this is from Ari Wald making the case, S&P 500, you know, traveling to 4,400. Notes are included, and the case is just like I said, we're in the sweet spot. We're in the third year of a presidential cycle, for which the first 2 quarters of that year 3 are the most bullish. Part of Ari Wald of Oppenheimer's bullish, you know, price target for the S&P 500 is predicated on the January effect, the January barometer, and the presidential cycle here. So, you know, yes, yeah, I've been following this for a number of years, and we just had it completed, right? We completed the January trifecta, folks, and that's coming after a bear market. Historically, you complete the January trifecta after a bull market. The following 12-month period has been positive, all 13 occurrences. So keep that in mind. Either way, you know, our job as investors is just to make sure we're calm, we're rational, we're not like the financial media. And that's what this graphic here depicts, okay? Because we're bombarded every day by the financial media, by CNBC, by Bloomberg, and all these, you know, news outlets with the hyperbolizing of the economic data, the earnings trend being poor, you know, and they bring on these strategists like Mike Wilson, like Josh Brown, Bear. No, I think we're going to make new lows, a recession, all of this commentary. But this cartoon is great. It's from Robin
Seth, Seth, who was it the other day? I think you were playing a video where some woman saying she was expecting bank failures.
I don't remember who it was.
And I'm going, what planet are you on?
Yeah. And that's what they bring out. It's like bringing out Katie Stockton, right? Of Fair Lead Strategies, or Liz Ann Saunders of Charles Schwab, or Liz Young of SoFi. And all they really do is, for the average investor, they develop this fear in these investors because, you know, they articulate this belief that things are getting worse in the economy, at the very least, getting worse in the economy, and therefore, you know, the equity market should follow in pursuit. But they're not valuing the fact that the market led last year. The market was saying things are going to get worse. That's why we had the bear market. It was saying earnings are going to get worse. It was saying the economy is going to get worse. Well, the economy is worse, if not just slowing. The economy has slowed. Retail sales have slowed. Manufacturing has gone into a contraction. Housing has been in a contraction, in a recession. That's what the price told us last year. Why do you think the price isn't going to rebound ahead of earnings when it historically does? Why do you not think that the market is going to rebound before GDP troughs, which, again, it historically does? So when they march these folks out, you know, again, know who they are, right? Liz Ann Saunders, she doesn't manage money. She's a strategist. She develops these strategies. They go down to the registered investor and advisors and portfolio managers, you know, at Charles Schwab. Charles Schwab, the registered investment advisors and the portfolio managers, they make decisions based on strategies. Same thing with Liz Young of SoFi. Like these are folks that are not making, you know, managing money, but they're on TV, you know, and they're espousing to these really less than optimistic outcomes and leading investors to believe, I don't want to, I'm not buying this. We're probably going to go down. We're probably going to retest the lows. And in the meantime, the market's been melting up from 3,500 to almost 4,200 today. That's 700 points worth of, it's going to get worse. It's going to get worse. That's what they keep telling us. And keep this in mind also, folks. Remember October of last year when we dipped briefly below 3,500? Were any of these strategists saying the market was cheap then? Were any of these strategists encouraging you to buy that value back then? No. They didn't think it was cheap enough then. They certainly don't think it's cheap enough today, closer to 4,200. When the heck are these people ever allocating money? Generally, it's not a matter of valuation. It's not. If you weren't buying at 3,500 and you're not buying at 4,200, has nothing to do with your belief about valuation. Everything to do about you're afraid. You were afraid at 3,500. You're just more afraid at 4,200 because the story hasn't changed. From 3,500 to 4,200, things are getting worse. That's all we hear. It's about you're afraid. This cartoon, the pilot has indicated we are going to experience a little turbulence. Please fasten your seatbelts. And here's the economist. We're going to die. Or that's the financial reporter. And here's the the other person. He's a financial reporter. So they hyperbolize everything. And you just have to know that. Again, it's one thing to be informed. It's a whole other situation if you're afraid. Informed, not afraid. That's where you got to be. That's where your emotional quotient has to be. And we're always considering. It's always about the positives versus the negatives. And you need to have this list. You need to have a list so that you can see objectively that you're looking at both sides of the story. Positives, in my opinion, disinflation cycle, dollar weakness. Earnings have been resilient, not great, but resilient. They're not awful. They're not as bad as the strategists have been telling us they're going to be. Bond yields already blinked. We're more than 100 basis points off of the high 10-year. The bond yields have already blinked. And historically, it's a positive sign for the equity risk premium and equities. We've had breadth thrust. Global markets are actually doing better than the United States. The presidential cycle, we're in the sweet spot. Labor markets are extremely strong to the extent that we're still expecting the labor markets to tighten up, to loosen, I should say. The jobless claims to start ticking up, job openings to start ticking down. We got the JOLTS report this week. We rose 600,000 more jobs were available than the prior month. Seasonality is great. We're in the perfect seasonal spot. Buy the hold is just always a winner. The negatives, however, Fed is still hawkish. We know they're going to continue to hike. At least that's what they're promoting or articulating to us. I can't say it's still a bear market today. We did, on an intraday basis, rally 20% off the lows. Closing basis, yeah, I get it. So we'll keep this in there. Recession probabilities aren't getting better. Not with the recent round of data, still mixed. Each month the data seems to, you have your pros and your cons. The yield curve, it's still inverted. So the lending impulse, right? Credit lending, it's not improving yet. Consumer sentiment, it's better. It's definitely still bad. Overall, the level of consumer sentiment is still bad, although it's improved off the lows. The housing feedback loop is still not positive until we see consistent. We're starting to see new home sale growth, existing home sale growth on a month-to-month basis, but we need to see a string of that. Until we do, well, the fewer homes that are bought, the less crap to go in those homes is going to be bought. And general market structure, still we're lacking liquidity. We're lacking liquidity. So those are, the positive and negatives. To be objective, to maintain our objectivity about, the macro market landscape there. You have anything to kind of add or maybe Yeah,
You
subtract.
know, I was thinking the other day, especially for newcomers to the market, I'm sure we've got somebody within all the people you've got, is it's a good time to think about the difference between a secular bear and a cyclical bear.
Mhm.
And the same thing with the bulls. Well, I don't think anybody can say with a straight face that we're not still in a long-term bull market
Yeah, secular
that
bull
never
market.
did end. That we've got a secular bear going on. And the reason I wanted to make that comment, for a secular bear market, this one has lasted a long time.
Well,
And
we can't define it. We can't define this as a secular bear
I
market.
mean, for a
Secular bear,
cyclical, excuse me,
yeah,
excuse me,
cyclical. Okay,
I got my words mixed up. For a
no problem.
cyclical bear, it has lasted for a long time,
Yes,
so it
this
would
is
not be surprising.
the
Yeah,
deepest and the longest in history. Yeah,
yeah. So it wouldn't surprise me at all if we haven't already bounced out of that.
I would tend to agree. All the signs of I have 10 what I call bear to bull market signals. 10 of them. As of this week, the last one fired. So, and that's only happened 3 times in my career that I, compiled this 10 signal bear to bull market. It's only happened 3 times. The last time it happened was 2020. Before that, we didn't. You said, well, what about 2018 into 2019, Seth? Because we had a bear to bull market, but some of the bear signals or bear market conditions were never satisfied in 2018 for me.
Right.
So it was still technically a bull market in 2018 for me, for my signals at least. So absolutely. Now, I had mentioned the yield curve here, right? And I just want to reiterate, because I know we've looked at this chart before. This is, how the market performs after the yield curve, going 12 months or 1 year and the 2-year period. And most of the time, markets are up. Most of the bars are in positive territory. Very few are in negative territory. Now, want to put the other chart that goes along with that, with the bar chart here. The red dots in form of where the yield curve inverted across the S&P 500 trend line there. And what we can distinguish is that if the S&P 500 already declined significantly, even if the yield curve, has been inverted, there hasn't been an additional decline. There hasn't been an extension of a bear market or a correction. See, in 1966, the market had already declined 22% by the time the yield curve inverted. Yield curves inverted, look what the S&P 500 does. And no recession, folks. No recession. Now, here we're closer to the top, right? The S&P 500 is closer to the top when the yield curve inverts. So what happens? The market goes down. Again in 1973, 74. Market is close to the top. Yield curve inverts. What does the market do? Go down. That's very different from what happened in 1966, where we were already down. Once again here, 1989 into 1990. Yield curve inverts. We actually do have a recession. The market still kept going higher. Here we are, this is 2000. Market's at the top. Yield curve inverts. We plummet. So what matters most is when the yield curve inverts, where was the S&P 500? That's what matters most. That's what's outlined in these notes here. In some instances, when the curve first inverted, the stock market was near its high of the cycle. That is, the S&P 500 had not shown any pre-inversion slump. It didn't price in the yield curve inversion, leading to an even larger post-inversion decline. In 1980, 2000, 2006, when the yield curve inverted, the stock market was either at or still rising toward its peak as the yield curve inverted, while in 1969, 1973, the S&P 500 had fallen only modestly before those inversions. Where are the dates? Here they are. Following the 1966, that's this first one here. The 1978, that's this one here. 1989, we already spoke about that. That's this one here. And the 2019 inversion, the S&P 500 had already priced it. Remember, in 2018, we had a 20% correction. The inversion came in 2019. We rallied 30% in 2019 into early part of COVID 2020. So it matters. We already, just like in 66, just like in 78, just like in 89, just like in 2019, we had already corrected for the inversion. It matters, folks. This is why I say, when these strategists come on, the Liz Saunders of the world, the Mike Wilsons of the world, what do you think last year was about? Price led these signals. And this is often how bears get trapped. It happens every single cycle, folks. I kid you not. Not occasionally, not most of the time. Every single time. Read it, commit it to memory. How to trap a bear. Now remember, there's no opposite of it. There's no such thing as a bull trap. Far too frequently, people say, what's good for the goose is good for the gander, right? If there's a bear trap, there must be a bull trap. No, not for the indexes. Markets go higher over time. You could lose time, but you're not trapped in the index ETF. You're going to get your money. You're going to get a profit. You may just have to wait longer. But if you're a bear and you're short the market, you're short the indexes, there's a low probability for you and a high probability you're going to get trapped. We have the longest and deepest bear market without a recession, to your point earlier, Brad. Have a Fed hike rates to fight inflation at the fastest pace in 40 years. Again, this is how to trap a bear. Have the equity risk premium shrink the most in more than a decade, again, without a recession. Disinflation then finally sets in for over 6 months as the rate hike pace slows, 75 basis points to 50 basis points to 25 basis points. Now watch the equity risk premium, because we even have a short and shallow recession. But what is going to happen if we have a recession? Inflation is going to fall even faster, and yields are going to follow that much faster. But the earnings they're not going to fall that fast. Earnings don't fall that fast. Nowadays, we're already seeing companies lay off workers to make sure they're managing the bottom line. They're taking cost out of the business operation. Again, this is why more often than not, earnings don't fall as fast as yields. And if they don't fall as fast as yields, what happens to the equity risk premium? It expands. It makes equities more attractive. Now watch the low PE of the former bear market. So the low PE last year was 15.5. Proves to be the low PE as the equity risk premium keeps rising in this scenario. Watch as the bears pound the picnic table about PEs expanding while in recession. Because 90% of the time when we're in a recession, the multiples, the price to earnings ratio expands, which it has done 89% of the time since 1950. This is the bear trap every single time, folks. So when you're watching CNBC, when you're watching Yahoo Finance, when you're watching TD Network Live, every time, listen to hear if they say the words valuation or PE. And if they do, no, the trap has been laid. It happens every single time. And I know this is like ringing in people's ears right now because that's all we have heard from these strategists that come on TV. Well, we haven't seen the typical, the average bear market price to earnings low of 14 to 15. I'm like, really? We had 15.5. Are you really going to put that fine of a point on it? Come on. So, and here's another. How often do we hit the average of anything, right? Averages are generally used for models. It doesn't mean you're going to hit the average, which is why this is much better. The PE recession trough since 1970. Now, this chart right here, the last 10 bear markets have an average PE derating of 7. We know that PEs expand over time. So usually your starting point for an economic cycle is higher than the previous one so far as valuations are concerned, or the PE. That's why it's often better to use the multiple points for a derating cycle. And the average has been 7. So we lose 7 multiple points for the average derating cycle. What did we lose last year? We started at 22. We got down to 15.5. Almost 7 multiple points. And again, remember, nobody was telling you to buy, even though this is your history. None of these strategists were saying to buy that 3,500 print. Here's the actual. Since 1970, these are the trough PEs. In 1970, 13.5. 1974, 8.2. 8 in 1982. 1986 was 15.5. 15.3, 2001, because the starting point was so high. I think we got up to a 30 times PE multiple during the dot-com period. So it only came down to 20. That's why using a derating system is better than using an average PE for a recession. And in 2008, 16.8. So when they keep begging for a 14 multiple, rarely did we ever achieve that. You have just as much of an opportunity to be above that or below it. So keep this in mind, folks, when we hear all this commentary from strategists. One of the things that we need to see, and we wanted to see in order to, again, signal that we're in a new bull market, is stocks need to stop making new lows and they need to start making new highs. And that's what we see going on here. In 2009, pretty much the trough of the market, right? In March of 2009. After that point, here's the new lows. Stocks hitting new lows. Almost non-existent. You were in a new bull market after the March low. Here, 2018, 2019, we had the fourth quarter correction, 20%. Stocks were making a lot of new lows. 2019, new bull market. Very few stocks were making new lows. Here we are today. A lot of new lows throughout the year. But look at what's been happening here in 2023. Character change. These are the the makings, the signals of a new bull market. Look at this here. Equal weight, consumer discretionary, offense versus consumer staples, defense. Look at the breakout here. Consumer discretionary outperforming consumer, long underperformance all last year. Consumer discretionary versus consumer staples. We've broken out, and that's not a minor breakout. These are one of those where you're like, holy crap, cheese and the monkey. That is massive. And it's confirmed by the RSI. This is the highest RSI. Now, I took this on January 27th, by the way. It actually kept going. I mean, it's even higher today, this breakout. Overheated in terms of, again, looking for consolidation of this market move to be expected. Like a 77 RSI is way overheated, folks. You need to anticipate some degree of consolidation near term. One of the other signals we have talked about in the broad market breadth momentum, the summation index, the NYSE McClellan summation index. When it goes from negative 1,000, historically, we went all the way back to 2002. It goes from negative 1,000 on the summation index to above 800. It was a new bull market. 12 months later, the market was always higher. But we went further than that. We got to 900 plus. I think we actually got to 1,000. Let's see really quick here. as of yesterday's close, because it only updates at the close. Did we even get to it? Getting above 900 has a 94%, yeah, above 1,000. Highest level we've been since 2021. Highest level we've been since 2021, folks. But here's data when the NYSE exceeds 900 for the first time in at least a month. As you can see, very little red. The only times we've seen red was 2007. That's a financial crisis. Do you think we're going to have a financial crisis here in 2023? More than likely not. So the positivity rate is above 94%. 12-month returns. This is 1 year later, folks. 1 year later, even 6 months. 6 months, you've got an 83%. 3 months, 88% positivity rate. So again, that just happened. Just happened, folks. The moving balance indicator, we've talked about this. This is one of my, also one of my 10 bear market to bull market, bear to bull signals. And this fired recently. Historically, markets just don't look back. Here's the 12-month later positivity rate and average returns. After this signal is completed, the MBI average return 21%. The only time it was red, 1987. We know, obviously, Black Monday. So that's the only reason why it was down that particular year. The only time. It spoke to the fact that, the 50-day moving average has crossed above the 150-day moving average. That happened last week also. And we're threatening to have a 50-day cross above the 200-day moving average this week. Excuse me. Still getting over.
You got my cough, Seth. I
Yes.
started coughing when I got on. Now you're doing it.
Still getting over my cold, folks. But
my fault.
That would be a golden cross. And if we get the golden cross, again, it's about forward probabilities. And historically, the average return, I think, is about 15 to 17%. But we were trading below the 200-day moving average, and now we're trading above the 200-day moving average. Typically, when you have that kind of conversion, a golden cross, the average gain is 20+%. All right. This one is from Nautilus Research. Monthly cross above 3 versus the 10-period moving average. And that just happened. It's happened, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 times historically since 1947. So this is post-World War II. Looking out 1 month, 7 wins, 2 losses. Going out a full year, historically, market has never been down. This is a new one from Steve Depp. The S&P 500 is on pace. It completed to finish the month of January with a trailing 4-month return of 10% or more and trailing 12-month returns in negative territory. Here's the precedent in the table above from Steve Depp. 1 month later, maybe, right? 77%. There's some red there. But 2, 3, 4, 5, 6, 8, 12 months later, there is no red on the screen, folks. That just happened. Consolidation. What's the composition of this market rally? Well, coming into this week, it wasn't fantastic because the on-balance volume is telling us that a lot of it was short covering. Historically, we tend to see, if we're in a new uptrend, we tend to see the on-balance volume participate in kind. And it just really hasn't until more recently. So it kind of validates the argument that a lot of this rally in the new year has been short covering. We are starting to see the on-balance volume curl higher, indicating that there are more buyers coming into this market as we rally. This is a prime example. Here we were 2009. This is the on-balance volume trending higher. There was the low 2009. And as the S&P 500 bottomed, moved higher, the on-balance volume was on trend. So it's very unique to see this kind of a move in the market without the on-balance volume ticking higher. And it really does confirm, that a lot of the rally is short covering. But also, I think that you will see a turn like this when investors do believe the Fed's going to pause. See, you didn't have to worry about Fed pausing here in 2009. They were full on QE. I think that's the distinguishing piece of information, if you will, in why the on-balance volume hasn't somewhat confirmed the new uptrend in the market. Either way, it also hints at, the possible future consolidation of this move. That's all I got, Brad. Any final words we want to leave our Finom group members with? Look, a lot of the stuff that we go over week in and week out, whether it's here at State of the Market or within our macro market research report delivered every Sunday, it's about building confidence. A lot of investors, they don't have the confidence to just buy, and that doesn't sound good, right? That doesn't sound educated. It doesn't sound like I'm doing risk management and whatnot. But as I often say, you can't manage the risk you don't take. You're just spinning your wheel, basically. I guess I want to ask, what are some or one of the things that make you confident when you're just buying, executing your game plan? What helps you in that respect?
Just that, knowing what my game plan is, which includes lots of cash on the sidelines. I've got incorporated into my strategy this year the possibility of a recession, and I'm like, okay, that kind of stuff doesn't bother me anymore. I think what gets a lot of rookie investors, and I don't mean that in a derogatory way, because we were just talking about that.
We were all novice at some point.
Yeah, less experienced investors is actually buying too much at once, because then you got no place to go.
Right.
Things come down, you're wanting to buy something, and before you know it, you're doing dumb things like buying on margin. Don't do that.
Yeah.
Or borrowing from your credit card so you can buy some more stock and this kind of thing. No, just keep lots of cash. So, because that affects your day-to-day thinking.
Right.
It really does. And it's better to kick yourself inappropriately, I think, at most times, that trade that got away. Oh, I didn't buy enough of that, or I should have bought that day. No, I mean, that just means you're
always going to leave money on the table, right?
Yeah. If you're not leaving money on the table, you're doing something wrong.
Yeah. People tend to, I think we lean too much into what we see, what other people are doing. And we have this FOMO of not making all the money, and I think that's the pervasion of social media, even financial media. People have incorporated this idea that they can make all the money, miss no opportunities. And that's just not reality. You get your piece. I've always been, of the opinion that if you can get your piece of a move, a piece, within your investment, if you can get the piece of any move, you're doing fine, because there's no possibility you are going to get all of the move every single time. Take your pieces, and don't worry about leaving money on the table.
Let's talk about.
Go ahead.
Let's talk about Facebook just for a second.
Oh, Meta, yes. Meta platforms, yes.
Buying. Yeah, Meta. I still hate that name, but
me too.
I had no intention of buying any Meta in the near term, and when it fell below 100, I went, well, what the hell, And Seth, I literally bought 10 shares. There was absolutely no confidence in that buy at all. And then it went up quite a bit, came back a little bit more. So I thought, okay, I'll buy 10 more. And it just goes to show you never know. That wasn't something that was in my game plan, but I just thought, that cheap, why not?
Yeah.
And I put so little in it that it really didn't matter.
As long as, that helped your psychology. If you get the upside, great. But if it goes down, it's not going to hurt me.
But I don't think I've ever made something like $1,500 off 20 shares of anything that that fast.
Now I'm in the other
And
camp.
and I'll admit, yeah, I'll admit that when it ripped, I sold it out uh, well before what did it rip to? 190s?
190, I think.
I think
Yeah.
it did.
From
And
from from
I just
from
dumped.
sub 90. From sub 90 to 190.
Yeah. And so I dumped my shares at 70 something because it not I'm not knocking Facebook, but it just wasn't really in my game plan, and I made my
Mhm.
little win there, so I
It was
got
just
out.
great value. You recognize
Yeah,
great value. The risk reward
yeah,
got skewed in favor of the reward.
yeah,
You know, when it dropped below $100, the risk reward got skewed
yeah.
dramatically in favor of a bullish outcome. I had been tweeting, we had been talking about it. I said it was going to have its Apple 2016 moment. It's got to drop below 90, and investors are going to flock to it.
Mhm.
Every now and then I get lucky with a call, and that
Yeah,
was fun. And I started building a position. Yeah, I was out there on Twitter saying, I'm nibbling. You do you. I'm gonna do me. This is an opportunity to me. I see that the risk is skewed now. Same as you. I sold before earnings. But I got it I was buying as soon as it broke 100, and I bought, I think, all the way down. I think my last position was like 87 and change. And I sold before, but I got, high 140s. It was fantastic opportunity in my
yeah,
opinion. Did I expect it to
yeah,
materialize this quickly? No. Do I care that it materialized this quickly? No. I just took my double-digit return. But you have to, in my opinion, that's good
yeah.
discipline. I wasn't trying to hit a home run. I think I got a triple out of it for sure. But it's good discipline, not to be a pig, so to speak.
Another thing I got out of that, I haven't dug into the whole report yet, but I saw the headlines, the main numbers that count, and their year over year is kind of stinky.
Oh yeah,
But
the sales
I
declined for a
think
third straight quarter. Yeah.
I think what the market participants signal is that in future earnings of other companies, and I'm talking about companies with longstanding track records, good blue chip companies, and so forth. They're going to cut them some slack if they just show they've righted the ship. I think that's what's going to happen.
I think what Mark Zuckerberg basically outlined is we're going to be better fiduciaries. We're going to focus on the balance sheet. We're going to cut costs. We heard that Meta, how much we've been allocating to the Meta platform build out is too much for investor comfort. Not much has deteriorated other than what has been caused by a slowing of ad spending, but the actual underlying business, the Facebook, if you will, hasn't deteriorated. So I think just Mark Zuckerberg informed investors that we heard you, we get it, and we're
Yeah,
going to make sure that we implement it going forward. And that's all it took. That's all it took. Because to your point, it's not like the metrics were that they reported were great.
no,
It certainly wasn't. So sometimes, and again, that's all it takes when a stock has been beaten up as bad as it has been, yet it still has the balance sheet that it has for longevity. Investors said, he's listening. I don't like what they reported, but for the love of them, these guys print billions of dollars every single quarter in free cash flow. How can you not? And they're the dominant player in the space. How you feel about Mark Zuckerberg, that shouldn't play into somebody's, decision to invest or trade. Put that aside. That's a personal bias. Focus on the numbers. Focus on the go forward strategy. With that, I hope everybody made a ton of money in Meta, and we'll see what happens tonight with Amazon, Alphabet, and of course, Apple. We'll see how long this trend persists without some kind of a give back. But as I always say, pullbacks after these bullish signals and technical achievements of strength, those are your opportunities, folks. Thank you for joining us, as always, here at State of the Market. Come back next Thursday.